Hey folks, John here with another Easy Options investing video. Today I'm going to tell you everything you need to know about a put option. Let's get into it. Alright folks, now before we get rolling, if you like this content and you enjoy this video, I would really appreciate a like and subscribe. Alrighty, now let's talk about the put option. Now today we are talking about my favorite put options. And if you're not familiar with what an option is, it's basically a contract that expires, and that contract governs 100 shares of a stock. If it's, for instance, Apple, Facebook. Now, the price of that option contract is actually determined, and it's dependent on what the price of the actual stock does. And that's why it's called a derivative. Now, it's not the only derivative out there, but it is one of the most popular derivatives to trade. So, now that you know what an option is, let's talk about put options. So, if you buy a put option, it's basically like buying insurance, okay? So, if you buy it, you really want the stock to go down, or that's what you think is likely going to happen, so you pay money for that contract. And if the stock does go down, you're allowed to put 100 shares to the person who sold that to you at that higher price. So let me give you an example. If Facebook was trading at, say, $100, okay, and you bought a put with the $100 strike, and then Facebook drops to 50, okay, well, that insurance you bought paid off, because what you're allowed to do is you're allowed to put shares of Facebook to that person, but you get to put them to them at 100, okay, but the stock's down here. So you covered yourself from that big fat loss. So that is the pretty cool thing about put options. And let me tell you, if you get the direction right, if you're right about the stock really dropping, you can have very significant gains. They can get into the hundreds of percents. Now, before we do a deep dive into how puts work, if you're interested also in understanding how calls work, I'm gonna put a link over here for you to check out. Okay, I also put together a graphic that will hopefully help you understand this a little better, hopefully not confuse you more. So here we have our profit and loss, right? And here is the price of our stock, and this would be the price increasing. So if we bought a put, we had to pay money. So, and again, we want the price to go down. So here's the price high. If the price starts going down, okay, we are in the hole until the price gets near our strike price, right? Because that's the money that we paid, and that's why it stays constant. But once we get past below that strike price, we start to get to near the break-even point here, okay? And once it gets to a certain point, which is basically the money that you paid for the option, that would be this right here. Once you get past that, you break into the profit zone. And you know, theoretically the price would keep going into the page, right? And the profit can grow and grow and grow. And so that's basically the P&L chart for buying a put. Okay, now let's look at the other side of the coin, selling a put, which is one of my favorites. So the line is actually going to be up here. Now, wasn't it down here before? Yes. Why is that? Because we sold the put. We collected money, which is what I love about selling puts. You get the money right away. Now, there is limited upside. That is the limit of your upside, is what you got paid just there. When you buy, and if you get the direction right, it can really be limitless. You can get huge returns if you get a really big follow through. But this is consistent. This is definitely consistent. So let's look here. Let's draw a dashed line here and let's come through here. Okay, so this is going to be our strike, and this right here, I'm just going to call it BE, that's going to be your break even. Okay, so if the price keeps coming down and it passes your strike, you start to lose some of that credit that you received, right? And the value. So it ultimately gets to your break even. And then if it keeps going down, ultimately that position is going to be in the red, okay? Now, if you let that contract go to expiration and you let it close, you will realize a loss. Now, what's pretty cool is there are ways to manage that so you don't have to take a loss. You can basically roll your positions. Now, there's a little bit to it. I'm not going to go over it here, but know that I've really never had to realize a loss myself I've always been able to roll out of positions, so it's a pretty cool thing when you're selling a naked option. Alrighty folks, thank you so much for staying this far along in the video. It really means a lot to me. Hopefully I cleared up any confusion about puts you had, and if you had any other questions, do me a favor, just leave me a comment below, and I will for sure get back to you. And also, if you like this content, please like and subscribe, it really means a lot. Alright folks, I'll talk to you soon.